Greetings traders and welcome back to another survival guide. Chris here bringing you some more information. Today we're going to talk about the Federal Open Market Committee, otherwise known as the FOMC. This is something that allows traders to potentially make a great deal of money due to the volatility if they have a strategy that favors the volatility, or to potentially hurt traders. So either way, however you trade the market, it is important to be aware of, because at the end of the day it doesn't matter if we don't like the FOMC's effect on the market. It's going to happen anyway. And to get caught off guard by it means to not understand when it's coming or what it's going to do to the market. So today we're going to cover exactly what the FOMC is and all of that good stuff. But before we get going, please make sure you click the like and subscribe button down below, because it allows me to keep coming out with these videos for you guys. So without further ado, let's dive on into it and learn about the FOMC. Psh. The FOMC, or the Federal Open Market Committee, is a component of the Central Bank of the United States, which is otherwise referred to as the Federal Reserve. The FOMC is responsible for dictating the monetary policy of the Federal Reserve System, and they control open market operations. The open market operations refer to when the FOMC buys or sells securities to speed or slow inflation and control economic growth. They are our overseers. Additionally, the FOMC oversees the Fed interest rate itself, otherwise known as the Fed funds rate. This interest rate is the rate that the banks charge each other for overnight loans, which are known as Fed funds. The FOMC also works in conjunction with the Federal Reserve Board of Governors to control the discount rate and reserve requirements. The discount rate refers to the rate that the Fed charges member banks to borrow from its discount window to maintain the bank's cash reserve requirements. The reserve requirements are basically referencing the required total amount of funds that the bank must hold on a nightly basis as a percentage of the bank's deposits. The FOMC's involvement in dictating the Fed interest rate is important because the banks use these loans to make sure they have enough capital to meet the Fed's reserve requirement. The monetary policy and the Fed interest rate are discussed 8 times a year at FOMC meetings, and the FOMC minutes from these meetings are available to the public. The FOMC's function and actions do affect our day-to-day lives even if we don't realize it. For one, the FOMC meeting largely dictates the economic sentiment as the economy sits as a whole. At these FOMC meetings, the Fed always explains its actions based on economic performance, primarily as it relates to inflation and unemployment. Second, the FOMC essentially stimulates or restricts economic growth and employment as well, so this is another function of the FOMC. The FOMC will increase the money supply by lowering the Fed interest rate and by buying more treasuries if it needs to. If the Fed wants to slow inflation, or if the economy is growing too fast and overheating, the FOMC will then decrease the money supply by hiking the Fed interest rate and selling more bonds. All of these actions behind the scenes affect our day-to-day life more than we most likely realize, and it definitely affects us as traders if you're trading during the time that this information hits the market. Here we can see what the open market operations and what this monetary idea looks like. The central bank purchases and sales of securities in open market as a way to implement monetary policy, and we see the securities coming and going and indicating the buying and selling. And this monetary policy tool is used for what? Well, it's used to help the Fed promote stable prices and to maximize employment by changing the supply of reserves in the banking system, which influences the interest rates and the supply of credit. At the bottom of the graph, we can see a couple examples of how this might work. With the FOMC, if they wanted interest rates to decrease, on the left-hand side here, we can see that the trading desk is directed to engage in open market operations, including purchases of government securities. This injects reserves into the banking system, and this puts downward pressure on the federal funds rate, and thus other interest rate, encouraging borrowing. And contrary to monetary policy, like tapping the brakes if we want to slow things down, the FOMC, if they wanted to increase interest rates, the trading desk would be directed to engage in open market operations, including the sale of government securities. Banks have fewer reserves that are able to lend, and this puts upward pressure on the federal funds rate and other interest rates, which then encourages saving. The importance of the FOMC just simply cannot be overstated. The FOMC is a key component of the Federal Reserve System, and it is completely responsible for managing the growth of the money supply for the world's largest economy. The FOMC essentially dictates the price of goods in everyday life by controlling inflation, dictating economic settlement, and contributing to provide liquidity in times of crisis. They also secure the integrity of the financial system at its very core. The FOMC controls monetary policy and keeps the U.S. financial system completely afloat. What a hefty job. If there was no FOMC dictating monetary policy, stimulating and bailing out the U.S. economy during financial crises like we have going on right now, who knows where the economic landscape would be today? It could be a whole lot crazier than we're currently experiencing, believe it or not. It is often predicted that the recession we are currently in and the prior one would have developed much deeper and lasted much longer if it weren't for the FOMC. As of September 2020, when this video was produced, the current list of the FOMC committee is as follows. We have Jerome Powell, the legendary, the Mr. Powell at the very top. Then we have John C. Williams, we have Michelle Bowman, and the list goes on and on. These are names that you may already be familiar with or have seen on TV mentioned at some point or another, and chances are it is because of their action with the FOMC. This chart shows the Fed interest rate all the way back to 1954. The Fed's interest rate decisions affect everything and can cause a ripple effect across the broader economy. From spending to borrowing to economic performance to stock and bond prices, these are all things that are impacted. When the Fed decides to lower interest rates, it does so to stimulate economic growth. These lower interest rates encourage borrowing and investing. Since it simply makes it cheaper to borrow money, more people borrow money. When it is cheaper to borrow money, both consumers and businesses are willing to spend more and invest more. As a result, in times of low interest rates, stocks often rise. However, when the rates are too low for too long, growth can become excessive and overheat, which then causes unhealthy inflation. When there's inflation, everyday goods become too expensive and purchasing power is reduced. This type of growth is just not sustainable, and therefore, the Fed needs to raise the interest rates to curb this inflation and slow the growth to a sustainable level. Often, when the Fed raises interest rates, the stocks will not perform it well during this time, and consumers and businesses usually are more fiscally conservative. Most recently, Chairman Powell doubled down on the current monetary policy and pledged to keep interest rates lower for years to stimulate and support economic recovery after the current COVID recession. The Fed, over the long run, will seek an average of 2% inflation rate and broad-based inclusive gains in the jobs market as part of this progress. The Fed plans to continue to stimulate the economy and inflation even if it is above the former 2% target, and as long as the average inflation remains muted, the current Fed will continue to try to stimulate the economy by controlling the interest rates. Going back about 50 years, we've collected some of the more important and historic FOMC decisions, beginning with Operation Twist of 1961. The FOMC wanted to flatten the yield curve to promote capital inflows and strengthen the dollar, and decided to shorten the maturities of public debt in the open market. The twist tactic came about by reselling some of this same short-term debt back into the open market and using the proceeds to buy longer-term debt. Operation Twist was only marginally successful, unfortunately, because it did not go on long enough. The FOMC did actually take a similar action in 2011. But then we have the Saturday Night Special, which occurred in 1979, which was when the FOMC increased the Fed interest rate by a full percentage from 11 to 12% during the weekend of October 6, 1979. Then we had the 2001 interest rate changes, which happened an awful lot. As a result of not only the dot-com crash, but but also the effects of 9/11 on the economy, the FOMC cut interest rates 9 times in the year of 2001 and 4 times after the 9/11 attacks, bringing the interest rate to its lowest level since 1962. And at its lowest, the interest rate dropped to 1.75%. And to put that into perspective, the Fed interest rate was up to 5% in just April of 2001. The Fed was desperate to bolster the money supply and wanted the consumer spending to increase drastically. Then we had the quantitative easing, which was the quantitative easing 1 per se, because there are others, and this was in what was known as the first step to recovering the 2008 financial crisis. The FOMC embarked on its first quantitative easing policy decision. This would forever change the Fed's policy and the way that the Fed functioned. Essentially, the quantitative easing idea, the Fed decided to pump in limitless capital into the open market to robustly stimulate the economy. Essentially, what we had going on was a shift as the FOMC purchased $600 billion in agency mortgage-backed securities, otherwise known as MBS, and agency debt. These purchases, however, had no impact on the Fed's balance sheet since they were largely offset by the Treasury sales by the System Open Market Account Desk. Now, in March of 2009, we could consider that the true beginning of this quantitative easing policy, because in March, the FOMC announced that they would purchase an additional $750 billion in agency MBS and agency debt and $300 billion in purchases of Treasury securities. Nothing offset the growth of the Fed's balance sheet at this time, and as such, this can be considered the true start of the Fed's QE policy. In December of 2015, another historic event happened when the Fed hiked its interest rate for the first time since June of 2006 by 25 basis points. Previously, the Fed interest rate was from 0 to 0.25%. The rate was then hiked to 0.25 to 0.5%. And more recently, we had the March 2020 coronavirus interest rate cut. This was a very crucial role that the FOMC played in our economic survival, as well as the subsequent stock market recovery that we've already noticed from the unprecedented COVID-19 crash. This was an emergency decision where the interest rate was cut by 50 basis points to 1 to 1.25%, the first emergency cut rate since the financial crisis of 2008. This rate was further lowered in another emergency announcement by a full 100 basis points, bringing us to a 0 to 0.25% range. So let's talk about how the FOMC decisions affect traders at different levels. The first is the Forex level. The US dollar is the world's reserve currency and is the most traded currency in the world. Any interest rate changes can affect it greatly. If the rates are higher, the US dollar normally strengthens. However, this means that it is bad to trade shares of other currencies during times where this is obviously higher. Lower rates generally weaken the US dollars and can be a boon for other currencies. Then we have the stocks. The stocks usually are averse to higher rates. Usually higher rates are bad for stocks as there is more risk aversion. Lower rates are usually a good thing for stocks in the past as investors usually look to take on more risk. Stock traders seemingly dislike interest rate hikes as a result, especially when they deem those hikes to be unnecessary. The Fed was seen as a major factor in causing the corrections at the end of the 2018 and the beginning of that 2019 period, with interest rate hikes that were largely seen as overly hawkish and unnecessary. And finally, we have the bonds. The bonds usually feel the brunt of interest rate policies more directly, and one of the most fundamental principles of bond investing is that interest rates and bond prices are inversely related. When interest rates rise, bond prices fall, and when interest rates lower, bond prices usually rise. This is what is known as interest rate risk. When it comes to trading strategies built around FOMC-style releases, usually they are just incorporating other news-based strategies because there is no one-size-fits-all action that will always result in the same outcome. And that's because the decisions are never exactly the same. And if they were, then we would have quite exaggerated movements as everyone knew what would happen before it happens. So trading the FOMC is something that you'll have to decide if it's right for you. If you love that high volatility and the ability to make an insane amount of money in a relatively short period of time due to the large price swings, then you may be very interested in learning to trade the FOMC or learning to incorporate a trading strategy that somehow favors that excess volatility during those high volatile news release windows. But other than that, thank you for joining me for another presentation learning about the FOMC today, and please, if you enjoyed it, click the like and subscribe button down below so I can keep coming out with these videos for you guys. Until next time, happy trading everybody, happy hunting. I will see you soon.